Something impossible has quietly become normal. Right now, millions of Americans are spending more than half of their take-home pay just to keep a roof over their head. Not on luxuries, not on lifestyle upgrades, on housing. And if you're feeling like the math doesn't work anymore, that's because it doesn't. This isn't abstract. This is the moment when your rent renewal jumps, your insurance premiums spike, your escrow payments adjust upward, and suddenly your monthly budget, it just snaps. And it not gradually, but it happens all at once. Families aren't budgeting anymore. They're absorbing the shock. And here's the pressure clearly named out, right? Buyers are being priced out. Homeowners are being squeezed after the purchase. Renters are being boxed into long-term dependence. And it's happening now, not years from now, because housing costs have detached from income reality. So for decades, Americans were told to follow one simple rule. Don't spend more than 30% of your income on housing. Reasonable enough? But that rule didn't disappear, it just collapsed. Today, the typical household would need to spend over 40% of gross income just to afford a medium-priced house. And that's before taxes, insurance, HOA fees, and maintenance touch the basic equation. So once you adjust for take-home pay, the burden pushes closer to 55 or 65% for many households. And that's not budgeting, that's survival mode. And here's the part that no one wants to really say out loud. This didn't happen by accident. This was manufactured. It was on purpose. It's engineered because home prices surged roughly 50% since 2020. Wages climbed barely half of that. Mortgage rates reset upwards. Insurance costs, they just exploded. Property taxes quietly followed inflated assessments. The system didn't break. It recalibrated itself against the households. Now, the headline is simple and somewhat brutal. The 30% rule didn't fail because people became irresponsible. It failed because the housing system stopped pricing homes for incomes and started pricing them for balance sheets. And that matters. It matters because housing isn't just shelter anymore. It's the primary transmission mechanism for economic pressure. When housing breaks, everything else follows. Savings, mobility, family formation, retirement. Think of today's housing market like a treadmill that speeds up every time you try to catch your breath. You don't fall off immediately. You just stop making progress. And that's where millions of households are sitting right now. And here's where the illusion even collapses further, because even if someone is willing to spend 45% of their income on housing, most won't qualify for the mortgage. Conventional lending still pretends the old math applies. Approval systems caps borrowers while real-world costs blow right past them. Now, unless you're using FHA or VA loans or bringing massive assets and down payments, the door simply doesn't open. Desire doesn't matter. Approval does. And when buyers clear that hurdle, the payment they approve for is only the beginning. Because we still have property tax resets, insurance premiums that surge, AOA assessments that just appear out of nowhere. Maintenance inflation creeps in quietly, then all of a sudden, all at once. Now, Zillow estimates these additional ownership costs can reach tens of thousands per year in high-cost markets. This is the hidden homeowner squeeze. The payment you budgeted for isn't the payment you live with. Meanwhile, renting, once treated as kind of a failure, has become a rational financial strategy. In many metros, renting is 50 to 100% cheaper per month than buying the same unit. Not because rent is cheap, but because homeownership has become structurally expensive, too expensive. I mean, picture two doors. One says own and the other says rent. But behind the ownership door is illiquidity, uncapped risk, and cost volatility. And behind the rental door is capped monthly exposure and optionality. More Americans are choosing the second door not because they don't want homes, but because they want to breathe. They want oxygen. This isn't ideological, it's arithmetic, it's math. In cities like San Francisco, LA, Miami, New York, buying the same unit you can rent can double your monthly outlay. That difference isn't equity, it's dead weight on cash flow. Now, for high earners, that gap is opportunity cost. For middle earners, it's disqualification. And this is why transaction volume is frozen right now. Not because people are waiting for rates to drop, but because even if rates drop, insurance, taxes, and prices don't retreat fast enough to restore affordability anyway. The system keeps moving the goalposts, but renting isn't without its own traps. Corporate landlords increasingly advertise artificially low rents, then layer mandatory fees like trash, technology, package handling, only after the application stage. Now, regulators are now stepping in because advertising rent without mandatory charges is illegal. Transparency has to be enforced because the system learned how to hide pressure. Still, renting offers one advantage ownership no longer guarantees: mobility. Because if costs spike or life changes, renters can just move. Owners absorb. And that asymmetry is reshaping behavior. The old American dream assumed ownership led to financial freedom. Today, ownership often delays it. The dream didn't die, it inverted. And some homeowners learned this the hard way. Low-rate buyers discovered that insurance spikes, tax reassessments, and escrow resets can erase years of perceived gains. Selling after years of carrying risk sometimes produces modest profits that vanish once true costs are tallied in. And even corporations see it. In Florida, Disney is suing over inflated property tax assessments, arguing counties are charging intangible value instead of real market value. And when even mega corporations are pushing back, it tells you something about how aggressive the system has become. Housing is no longer a market responding to supply and demand. It's a machine designed to extract cash flow from households long after the purchase decision is made. And the resolution isn't panic, it's clarity. We have to see all this clearly, because buying still makes sense in some situations, renting still makes sense in other situations. The mistake is treating either as a moral identity instead of a financial disposition. And the winning move now is flexibility, liquidity, and awareness of hidden pressure. All right, guys, what do you think? Do I have this all right? Do I have it all wrong? Please put in the comment section below. I look forward to reading and replying to all of your guys' comments. And once again, guys, thank you so much for watching me here on The Baseline. All right, cheers, everybody.